The S&P and NASDAQ are on track for their fourth positive month in a row. Our next guest is out with a new recommendation. They'll start investing in cyclical value stocks like banks, real estate, and insurance. Join us now, Barry Bannister, Stifel Chief Equity Strategist. Barry, we've talked about some of your calls historically over the year. At the beginning of the year, was 4,400 your target? I think it was close to that, wasn't it?
Yeah, well, from October of 22 to June of 23, we participated in the rally, but I think we end the year at 4,400, but that belies a lot of volatility the next 6 months. Investors are going to get chopped up by the market's gamma, but we're treating the third and fourth quarter as really discrete events. Third quarter, you get this relief rally in cyclical, but fourth quarter, the Fed's reaction function is going to be too slow. We're going to have a sell-off September, October. Maybe the Fed will cut November, December, and then we'll get a year-end Santa Claus rally. But I don't think we end the year any better than we are right now on the S&P or NASDAQ indices.
It's kind of funny because a lot of the people that really weren't looking for much of a year are now pointing out that you get a good first half, and typically you get a double-digit addition to that strong first half. So some people have talked about an additional 10% in the second half of 2023. You think the lion's share of the gains have already been realized?
I try not to use too much of the historical non-comparable period witchcraft. I mean, I'm looking at this thing in terms of the economics. I think the GDP is fine for now. And with the market, in terms of the cyclicals, it was just the avoidance of a classical recession due to that massive money dump during COVID in the first half that saved us. As we go into the third quarter, it's the avoidance of a outright recession in industrial production, the PMI indices. It's that avoidance that gives you the cyclical bounce. But then as you get into the year end, the Fed will catch up with us. I think GDP will fade, unemployment will start rising, and their reaction function is going to be just too slow.
Do you think the Fed will overshoot? So they won't, if it's not happening till then, they're going to think that they still need to keep tightening. You think they go another 50 basis points?
Well, if you look at the Fed funds rate minus core PCE inflation, you can use 3-month annualized, 6-month annualized, or year-over-year, whatever. What's going to happen as we go through the year is that inflation will slow, and they're going to stay at the same rate. So the real interest rate, the rate after inflation, will rise. That's called passive tightening. That might be at a level that's restrictive, very restrictive for equities by the fourth quarter. And like I say, they're so dogmatic now. I think their reaction function is going to be slow. They'll let things worsen first, and the market will see that and sell off September, October timeframe.
Are the 7 horsemen of technology, are those are not cyclicals, or do they have cyclical characteristics? Well, they won't.
Yeah.
Go ahead.
Well, big tech is cyclical growth, right?
But
so semiconductors are nothing but. Yeah, they're not value. No, when you think about big tech, what they are is like very short cycle capital goods. That's a semiconductor. A capital item, even if it's expensed for a corporation, is going to be software. So there is a cyclicality to big tech, and that was part of their rally. The other part was obviously AI.
Do you have can you look even further than 2023? When do you think the S&P finally eclipses its old all-time high?
Not until about 2026 at the earliest. We've had a secular bear market since December 30th, 2021. The S&P was, in nominal terms, around 4,800. In real terms, adjusted for inflation, it was about 5,250 on the S&P 500. I doubt we see that level again for many years. As a consequence of PE compression offset by nominal earnings growth, the environment is going to be aggravated by a more reflationary impulse, particularly for commodities. And we're not done with commodities. They're bottoming out here. I would add energy to that list of stocks to accumulate here, energy and energy service, because oil and geopolitics are going to be a toxic mix in 2024.
That would be a 5-year secular bear market, which we haven't had in a while. And a lot of people said that was the regression to the mean, or whatever, reversion to the mean, that was going to be in the cards. Guys like even Stan Druckenmiller, I think. And you're not talking about why it happened, but certainly staying at zero for so long has its consequences with the Fed. But that would give us a 5-year. I mean, that might be kind of healthy or cathartic to have had a 5-year period where you didn't make any headway. That might set you up for, an eventual secular bull market. But that's a 5-year secular bear market that you just described, 21 to 26.
Yeah, that's been our call. And, beyond just the 7 years we spent at zero rates that Mr. Druckenmiller talked about, I would add one other thing. When you dump as much money into the economy because of COVID as they spent on World War II in the United States and just adjusted for inflation, not only do you buy off some of the signs of a traditional recession, which was our call for that 4,400 rally, but you distort every single aspect of financial assets and economic behavior, including the labor markets now. It was just bad policy. Only private investment and work create income. Government handouts don't. And as a consequence of that, we are in a very difficult period, I think, for investors in the coming years as we wean off that impulse to spend just unbelievable amounts of money. Again, $5.8 trillion.